a new year is always a great time for stock taking. There are new hopes for the Indian economy in terms of probably lower crude prices, a nascent private capex cycle ticking up, and perhaps cheaper cost of capital. On the other hand, there are new challenges, especially from the global scenario where liquidity could be tightening, where perhaps trade wars could still make space a little difficult for us, probably slower growth for the global economy as well, and especially for the two big economies, the US and the Chinese economies. How do all this tie up in terms of prospects for the Indian economy? We're going to ask someone who is best placed to answer that. Sanjeev Sanyal, economist, environmentalist, author, urban realist, and of course, principal advisor to the Finance Ministry. Sanjeev, thank you very much indeed for joining us. Well, actually, let us start with the global, because every day we are getting bombarded with either tweets or an extremely volatile Wall Street indices. How are you looking at the 2019? Are we going to see this balance sheet crunching by global central banks beginning to make the cost of money expensive? Is it a difficult 2019 for us as far as the world is concerned?
Let me begin by wishing everyone a very prosperous and happy 2019, and a very happy birthday to you, Lata, as well.
Thank you. Thank you, Sanjeev.
So the world, as we look forward into it, yes, certainly there are a lot of uncertainties. But on the other hand, some things have also flowed our way. For example, oil prices have come off a long way from when they peaked in October, November. If you remember, they were at 85. Now we are looking at 53. So much better. Yes, there are some apprehensions about the world economy slowing down. But on the other hand, remember, the US Fed has suggested that it will probably tighten somewhat at a pace that's somewhat less steep than had otherwise been, which, by the way, is very good for us, because it means that the global liquidity conditions of anything will be somewhat easier than we had earlier anticipated.
Okay.
There may still be some tightening, but much easier than people had anticipated earlier.
Okay.
Yes, of course, trade wars make things uncertain. But again, as I said, not entirely gloomy. I mean, there are areas where if we in India, look at it positively and try and find ways in which India can, insert itself into a new global supply chain that may be emerging out of these trade wars, then in fact we can take advantage of it. So I would argue that yes, there are some challenges, but there are many areas where, in fact, India can take advantage of the situation, from lower energy prices, somewhat easier global interest rates, and perhaps a liquefied global supply chain where we can insert ourselves. So, and many other things as well. So I think not really such a gloomy picture of the world as maybe somebody else would have told you.
All right. No, actually, I want to connect this to the book, that your forthcoming book, India in the Age of Ideas, where you are, I think, trying to define a new role for India, understanding India's history in a new context. But I'll come to that in just a bit. Let's first explore the economy themes of 2019 and then come to how we should relook ourselves in a new global order. The Indian economy itself, the most immediate news that we are getting is that the fiscal deficit is now 114% of the full year budget. It normally tends to be higher in the months of November, December, and gets corrected as advance taxes come in the last quarter. But nevertheless, it's a slightly higher number than we are used to as early as November. Plus, we hear that the government is planning some kind of a farm support, maybe a basic income, maybe a waiver, maybe some way of supporting farm prices. It does look like fiscal deficit is going to get much bigger than we thought.
Let me just clarify that we continue to remain very much committed to fiscal consolidation. So we are not, contemplating moving away from that commitment.
Okay.
As far as the farm sector is concerned, I think we need to be clear that, you see, what is the issue that the farm sector is facing? In the past, the problem used to be for drought or floods or whatever weather-related factors, we used to be a shortage country. Now what has happened, ironically because of our own success, in fact, in increasing farm production, we have ended up in a situation where we are producing a lot more food than we could possibly consume. So this whole 1960s green revolution approach to agriculture that we used to have is basically run its course. We now produce way more food than we could consume or store, and so we need to relook at that. Now, how do we transition away from this let's grow more calories approach to agriculture? Okay. Now, first thing, short term, we need to make sure that the fact that there is this excess is leading to food prices being under continuous pressure downwards.
That's right.
We need to deal with that.
Okay, so agrarian reform more than an agrarian revolution or a green revolution is what you're talking about. But important for me is that you reiterate that fiscal deficit, in spite of whatever farm supports we give, will not get disturbed. The government is still looking at 3.3%?
We are committed to that 3.3%. Of course, there may be some variation around it, but you know, the variations that we will be very minor. I mean, this is not the days where we used to debate 5 and 6% of GDP.
No, certainly not. Certainly nowhere near that. But let me come to the cost of capital itself. Like you said, that we've got a severe food disinflation, which has actually been surprising. One thought that MSPs would perhaps increase the prices. That has not happened. And now to add to that, we also have a fuel disinflation. So what do you look at in terms of how much rate cuts can come? We already have a fairly comfortable liquidity with the Reserve Bank promising 50,000 crore of bond purchases December, Jan, Feb and March. To add to that, how much space for rate cuts do you see in 2019?
Firstly, let me clarify that this is really the prerogative of the Monetary Policy Committee. So I can't comment on exactly how much they should cut. But I can lay out the landscape.
Okay.
Basically, inflation is now running at the bottom of the range that the Monetary Policy Committee had been given. And we have now, it's just not something new, we have now had for some time inflation running at or below the midpoint of that range.
Opposite.
So inflation, I think, has structurally come off. I think it's fair to say that the old 7 or 8 to 10% range of inflation that we used to have, that has been lowered by some good, 500-600 basis points. So if that is the case, we need to see a commensurate reduction in the nominal interest rates. Otherwise, you have real interest rates running about the highest in the world. I mean, small business still borrows at 12 percentage points, right? Now, if inflation is running at 2%, that's 1,000 basis point
real interest
rate. Clearly, 1,000 basis point, at least an 800 basis point real interest rate for large parts of the economy. This is clearly not tenable because of a variety of reasons. First of all, this is a source of enormous financial stress to the balance sheets. So this is a major problem for small business, large business, for farmers. After all, farmers can also be seen as small business, and so on. It also causes stress on our fiscal side because the government is, after all, the biggest borrower from the system. So it is a stress on the fiscal side. But also, ironically, keeping high interest rates over long periods of time also increases inflation. This is something that economists tend to forget. That while high interest rates in the medium term lowers inflation, in the long run, high interest rates mean that you do not build capacities that you would have otherwise built, whether infrastructure, in industry and so on. So you end up with higher supply side inflation in the long run if you keep interest rates high indefinitely, irrespective of where inflation is. So I think we have structurally brought down inflation. We now need to take step 2 and structurally bring down the interest rates so that they are in sync with the new level of inflation. And that, when I say, when we have to think in hundreds of basis points. Now, exactly what trajectory the MPC takes, of course, is their prerogative.
No, a fair point. It's just that I would assume that the MPC would be convinced of the food disinflation that they have seen and the fuel disinflation, especially if crude continues around this $55 mark all the way up to February when the MPC meets next. But more importantly, they will worry if fiscal deficit is higher than they thought. For instance, we have seen a spate of farm loan waivers coming in from the state governments. In addition, if a big package comes from the centre, that would be a spot of bother for MPC, won't it?
So I would argue that you cannot see these things in isolation. I mean, one of the points I make in my new book is that you have to think about the system in a holistic way because everything is connected. Yep. If you keep real interest rates at these high levels for the farmers, naturally there will be pressure to do farm loan waivers and other things. Okay. So you make cost of capital exceptionally high, then it feeds through, the imbalance shows through somewhere in the system.
Sure.
So the point is, once you have lowered food prices and inflation generally, you have to allow the rest of the system to adjust. Otherwise, the political pressure or other economic pressures will show up somewhere. Okay. So these are not unconnected things.
Okay, fair point. Well, let me come to the other space that's, that was a problem, but increasingly a lot of NBFC guys, we had Rasesh Shah on the channel, the FICCI head, and he heads a big NBFC as well, telling us that the debt problem is not as serious as it was at all. K.K. Mistry said much the same thing. Do you think that that NBFC problem is now resolved?
Well, it certainly eased up a lot from where it was if you go back to October. If you remember, we had, of course, it got triggered with ILFS. We in the government moved very quickly and we ring-fenced it. But by that time, of course, the impact of that had gone into the credit market and the credit market had begun to freeze over. Now, this is, in India, we tend to spend a lot of time thinking about the stock market, the equity markets. Yeah. But credit markets, very few people look at. Whereas, in fact, the credit market is the heart of the economy in many ways. And so this was actually something we paid a lot of attention to, especially since we were seeing that there was a lot of problems with rolling over and so on. And of course, we took a lot of steps and I'm pleased to see that that rollover problem has substantially abated. This is not to suggest that we do not watch this carefully still. We continue to watch it very, very, very carefully. Okay. But for the time being, it appears that the NBFC situation has eased very substantially. We also have a good news in that the banking sector, which has not been lending for several years, has begun to lend again. Yes. So, the credit which the NBFC sector may have tightened up, the banking sector has begun to pull in. And of course, we have, additionally, you have, we have just recapitalized many of these banks. Yes. And so on. Large OMOs are being done to put liquidity back in by the Reserve Bank. So all of these things together have eased up the situation very substantially. Okay. No, absolutely. The banking system's credit growth is the highest, I believe, since December 2013 at 15.6% when the RBI last announced the number. So clearly, banks are coming in into the space that NBFCs have are vacating or at least have contracted. But do you think a special line of credit is needed for NBFCs? That was the kind of demand that lobby apparently made to the Prime Minister. But the Reserve Bank Act allows a line of credit only against government securities. That is in the Act itself. Besides, since the biting part of the problem is over, do you think just allowing liquidity is enough or a special line of liquidity is called for? Well, certainly generalized liquidity needs to be managed and the RBI is well aware of that. You may have seen the OMOs and other things have been ramped up. Whether or not NBFCs need a special window of credit or something, well, obviously that is not for me to say. Okay. The Governor Das will take a view on that. Okay. All right.
What would your worry be about infrastructure in general? We have seen the private capex cycle kicking off, but larger infrastructure, who will actually finance? We're seeing a reasonable amount of risk aversion in the banking system, primarily because of the catharsis they have come through, the IBC process, and even, of course, a lot of investigation that happened in the past 2 years. Do you think that there will be a problem? People are talking about already fresh power capacity that needs to be planned. There were reports that came from Credit Suisse and CLSA saying that in 4 years, we may actually start talking about power shortages if we don't start investment. Do you think we'll have a problem there in terms of finding investors for long-term projects?
So we of course remain committed to creating more capacities for infrastructure, whether it's power, roads, and so on. I mean, some very large projects have just got completed, and so on. So you are seeing, a large amount of investment going into infrastructure. It's not like we are withdrawing in any way. And of course, the private sector is more than welcome to come in and participate. There have been, it is true, problems in the past with certain projects. And of course, the IBC process has been put into place in order to take into account and liquefy them where necessary. And appropriate action will be taken wherever necessary.
Okay.
But of course, the government requires private participation, and it also requires the financial institutions of various kinds to take part, whether it is the banks or perhaps other new institutions which are specialized in long-term lending. You have a new institution, for example, like NIIF, which has raised money, but it is now beginning to deploy it.
Okay. Okay. Well, I have to take a break, Sanjeev Sanyal, but I'm coming back in a jiffy with a few more questions and interesting trends that you may watch out for in 2019, as well as we would like a peep into your new book. We are back in a jiffy.